If you're a startup founder, you've probably heard people say things like, you need to raise money, go find investors, or maybe just bootstrap it. But what does startup fundraising actually mean? More importantly, when should you do it? How should you do it? And what mistakes can destroy your company before it ever gets off the ground? That's what we're going to talk about. I'm securities attorney Kendall Almerico, and for more than 30 years, I've advised companies with legal issues that include how to successfully raise capital. For more than a decade since online securities sales became legal, my law practice has worked with startups, growing companies, and even a unicorn, helping them raise capital primarily through Regulation Crowdfunding, Regulation A, and Regulation D securities offerings. And here's the first thing I tell almost every founder I meet. Raising capital is not validation. Just because investors will give you money doesn't mean that you have a good business. And just because investors won't give you money, that doesn't mean you have a bad one. Startup fundraising is simply the process of exchanging ownership or debt for capital that you use to grow your company. That sounds simple, but there are dozens of ways to do it. You can raise money from friends and family. You can raise from accredited investors. You can raise from the general public. You can sell stock, you can issue convertible notes, you could use a safe, you can bootstrap, you can borrow, you can load up your credit cards, you can use crowdfunding. The question isn't whether you can raise money, the question is whether you should. I've had clients that raised millions of dollars and then failed. I've had clients who built incredible companies despite raising very little money. Capital solves only one problem, the lack of money. It doesn't solve bad products, bad management, bad timing, or a market that simply doesn't want to buy what you're selling. So when should you raise? Usually when three things are true. You know who your customer is, you know how to acquire customers, and more capital will accelerate growth. If you don't know those things yet, raising money simply may just make you fail more expensively. And yeah, I've seen that happen. Today, founders have more fundraising choices than ever before. Regulation Crowdfunding lets you raise money from ordinary investors. Regulation A allows you to raise millions from the general public. Regulation D allows you to raise an unlimited amount of money from accredited investors. Each has their advantages, each has their drawbacks, and when choosing the wrong one, it can cost you time, money, and flexibility. So what's the good news? Most fundraising mistakes are avoidable. The bad news, many founders don't discover that until after they've signed documents they don't understand, which is a pretty good reason to talk to somebody who does understand. So if you're considering raising capital, I've created videos explaining Regulation Crowdfunding, Regulation A, Regulation D, SPVs, funding portals, broker-dealers, and the rest of the private company fundraising ecosystem. Take a look around, and if my firm can help, I'd love to hear from you.